Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to answer your questions, try to make sense of markets that don't make any sense, and talk macro. And as I promised you on Monday, we're going to talk gold. I got all the toys out. We got the arrows. We're talking about bonds. Got the gold playbook. We're going to look at gold and real yields. Kind of cement why I don't think it's the right time for gold. It's completely against the consensus of the market right now. But, I don't always beat to the same drum as everyone. And I could be wrong. The thing about macro is you're not always right. You can see what's coming. Doesn't mean you're going to be right, but you can generally see what's coming. But in my view, I think gold goes down before it goes up. I'll give you some more evidence. But I think when the time does come for gold, it's going to be big. We'll look at that as well. So I want to get to your questions. I want to talk about what's going on in the news today. Obviously, if you didn't see it, there is a big build in crude oil today. Huge, 19 million barrels from last week. Massive build. I believe it's the largest weekly build in history. Could be wrong on that. But for a lot of people believe that the economy is just magically going to right back where it was. First, it was already slowing down. Japan was in a recession. Europe was unadmittedly waist deep into a recession. And we were slowing rapidly down. So the notion is, hey, the economy is going to rebound. That means we're going to rebound right back into the slowing economy we already had, except at a slower rate. And so for some reason, everyone thinks that the coronavirus is really the culprit to all of our ails. It is not. We were headed into a recession before this. We're just now fast tracking our way in. But for those who do believe we're going to rebound back very quickly, crude oil at $20 isn't going to do it. And that is a problem because in the oil market, you're going to have a massive amount of layoffs, bankruptcies, corporate failures, you name it, it's going to happen. And those are high-paying jobs in a lot of cases. And when those people hit the unemployment line, they're not going to come back for years. Now, if you think, man, there's going to be a bottom in oil and I can't wait to get it, don't worry. If you're looking to buy oil company stocks, you've got years to wait. Because whatever bottom there is coming, it's going to be there for a while. It's going to take a while for this to work itself through the system. So you got other things you can focus on and not feel like you missed out on that at all. Because what first is going to happen, the stock prices and the energy companies will have to tank more. Then they're going to cut their dividends to get more people to exit out. And then it's going to take all the executives, board members, and they're multimillionaires, billionaires, and at these major companies, former, current employee executives, they're going to buy up all these shares. And it's going to take them a long time because oil companies have massive amounts of share issuance. It's going to take them a long time to buy up a lot of these shares. And then what will happen is they'll start raising a dividend because they want to get paid, and then the price will take off. So you've got a long ways to go on that. But the interesting thing in the news, obviously we had retail sales. I want to talk about that. And let's take a look at retail sales. And I don't normally get too focused on this report. And because of what I first like to look at is the cash freight shipment. And if you work in logistics, or we'll just say international freight, maybe your cargo, maybe your airplane, if you work in that industry, well, you're part of the macro economy. You're going to see things happen before everyone else. And so we already knew that retail sales had to be slowing because the cash freight shipment index was already headed lower. And lo and behold, what happened? Now, granted, obviously, this is exaggerated due to the coronavirus, but we did know that at some point, retail sales were headed down because there was less stuff being shipped. And if you're a retailer or a wholesaler and you're buying less stuff, it's because there's less demand. And you can see the cash freight shipment index leads retail sales lower. So we knew that was going to happen. Now, if you kind of wonder how we would know that anyways, and why Steve loves bonds so much, is because bonds tell you what's going to happen. It just doesn't tell you when. So here, if you look at 10-year treasury yields against advanced retail sales on a year-over-year basis, and whoops, that's what the problem was. I knew there was something that didn't quite look right. We don't want percentage change from a year ago. We want percent. You can see the 10-year Treasury yields tell you or validate what's going on in retail sales. So you can see retail sales are rising, rates are rising. Rates start to peak and roll over. Retail sales start to peak and roll over. Rates head down, but retail sales head up. No, retail sales head down. That's the great thing about the bond market is it tells you so much. And if we zoom in here, we already knew retail sales were going to head lower. And they're still going to go down, even if the coronavirus never happened. Again, I don't think we would have seen this big of a move, obviously, this month, but it would be heading lower and heading lower pretty soon because interest rates tell us the general direction of what's going on in the economy. And when interest rates go down, financial conditions tighten. And when financial conditions tighten, think of it as your budget. What does it mean when conditions tighten? Your wallet's not as full. Your bank account doesn't have as much money. And do you go out and spend when you don't have as much? Generally not. So one thing I do like to look at, and it obviously is going to be very skewed, is the advanced retail sales of food and drinking places. And the reason I've always liked this, and let me back off today's number, is because it tells you once the year-over-year percentage change in growth falls below just a little over 2.5%, it tells you the economy's headed recession. It's a very good predictor of recession because when people stop eating out, what is it telling you? They have less money. Because what is the first thing that people do, right? You get a new job or you get a promotion. What does everyone? Well, let's go out to eat. Right? It's your birthday. Let's go out to eat. Oh, something good happened. Let's go out to eat. Something bad happened. Well, we should probably go to the bar. I mean, it's just an American thing. It's always something around food and going out to eat. So I like to look at this, but it's totally skewed because you can see today's report, boom, on a year-over-year basis, people eating out dropped 23% from this time last year. Wow. If we zoom that in, I mean, it's just ugly. I feel bad. There's a lot of very small restaurants, family-owned restaurants that are not going to make it through this, and it's a real shame. So then there was capacity utilization came out. Capacity utilization is really interesting from a macro perspective because it tells you what percentage of factories are being utilized. So if you had a factory utilization that was, say, sitting up here at 88, 89%, well, what is that going to tell you? There's a massive amount of inflation going on because the factories are humming, they're putting things out, people are buying, money's moving. Well, in recessions and heading into recessions, capacity utilization falls. Now, it's obvious due to the coronavirus, we would expect an outsized move here. But once again, the bond market tells us everything we would have needed to know. If we overlay 10-year Treasury yields here, we could have predicted this because that's what's fun about macro. Again, you can see what's coming. You just don't know always when it's getting there. So you can kind of look smart for a while. But if you're wrong by more than a few years, your friends will think you're weird about your strange predictions. And then when they do happen, they'll be like, well, you were way early on that. And what you can see here is yields. When yields head down, financial conditions tighten and capacity utilization falls. And we can see that capacity utilization is kind of lagging a bit where yields are going. And so as yields go down, it was only inevitable that capacity utilization falls. It's only inevitable. And again, the key thing to this is the Fed tightens monetary policy. And when you tighten monetary policy, when you ease monetary, let me restate that. When you ease monetary policy, it causes rates to go down. And in our monetary system, lower rates tighten financial conditions. And tighter financial conditions mean more people lose their job, factories aren't being utilized, there's lower retail sales. And it's so odd because everyone thinks that easing is great, and it's not until it is. And then the last thing that came out was the major foreign holders of Treasury securities, and lo and behold, $200 billion plus increase in foreign-owned treasuries. So people think, oh, the bond market was dead. Well, in February, certainly it wasn't. Foreign central banks largely, and large foreign investors were certainly buying bonds, with Japan and China both net buyers. So a lot of people said, wait a minute, China's selling. Well, they're buying, and I believe this is not quite their largest holding, but it's not far from it. So very interesting in the data there. All right, let me close some of these out so they're out of the way, and let's get to your questions. and see how prepared. Now we're backfilling here. So I have a few questions for you. One, do gaps formed in post and pre-market trading typically get filled in the same way that usual gaps tend to get filled? This is a good question, and it's for those of you who don't know what a price gap is. What I really enjoy about this channel is we don't just answer questions. I'm going to show you if you're not familiar with it. So what a gap is, and you can see here on the S&P 500, there's a gap between the closing price on February 21st and the opening price on February 24th. This is a gap. And if you look in here, there's a gap, a little gap right in here, and a small gap here. And we had this island gap reversal. I can't explain it, and I've really honestly tried to get a decent answer to this, but the market likes to fill gaps. There's no rhyme or reason. There's nothing that says you must go fill an overnight gap. Now, how do they form? Well, it's really simple. The U.S. markets close, and then in a couple hours, the futures market will open, and then a little while later, the Asia markets open. And if people are trading the futures or in foreign markets that are trading futures drive U.S. equity futures up or down, it's possible you can get a gap. So they do tend to fill. I can't give you a good reason why, but that they will eventually all fill with like a high 90% probability. Do you know of any good resources in addition to your show? Well, thank you. To begin learning more about the bond markets and other economics which affect the market. I don't, and that is a problem because a lot of the information that I have curated on the bond market has been piecemeal. I found experts like Dr. Lacey Hunt, who writes at a very, very high level. I've watched some of his videos, but I paid for some of the videos of where he's spoken at. A lot of the books I find are wrong. You really need to be reading books on monetary policy, and you can kind of start connecting the dots a little bit. I've read stuff, I think John Malden, but a lot of the stuff is subscription service basis or things that I picked up here and there. Milton Friedman, he did some early work on the bond market and the effects of interest rates on monetary easing and tightening. He didn't really get to finish his research, or I don't know if he intended to, but he laid some of the early groundwork. Unfortunately, there's just not one resource, and I wish there was where I'd send it to you. So what the hell is going on in the markets? This rally is incredible and violates common sense, in my opinion. Well, that's what this channel is about, right? Making sense of markets that don't make any sense, and bear market rallies don't. And so what we have is we're in a momentum-driven market. And there's two factors here. One, everyone at the peak of bull markets going into the bear market has full faith and credit in the Federal Reserve. They believe, after a Fed creates a bull market, that they totally believe the Fed can prop up asset prices. Now, I don't know why we believe this, because there's zero evidence. And if there was evidence to support it, then why have we not done it in the last two recessions when we had the Federal Reserve? Did they just not do enough of it? Was there some weird thing that they didn't do that we're going to do now that, that's the thing that keeps stock prices up? The other issue, as I said, we're in a momentum-driven market, meaning about 80% of this market is computer-controlled. And a lot of it is in what are called momentum strategies. And they're honestly super easy to write. I actually, before I invented Portfolio Shield, I did dabble with making a momentum strategy. I mean, they're not hard to do. You can use moving averages, rates of change. You can do lots of things. But effectively, everybody has created a strategy that if the markets go up, buy more. But they're all lagging strategies. So once the market starts going up, then they start buying in more. And then the market rolls over, because a momentum strategy has to wait till there's a shift in momentum. It's usually not, these strategies are generally not predictive. And kind of what makes my strategy a little different, not that I'm trying to convince any of you to do it, just to give you a perspective of when I created Portfolio Shield, because it looks at the relationship between treasury yields and stock prices. As you know, treasury yields lead stock prices lower on average by 3 months. And we also know that stock prices bottom ahead of treasury yields. So if you understand those relationships, while I technically cannot say that my strategy is predictive because of compliance here, they'd probably knock me out of my chair. The fact that yields do lead stocks at the top and stocks lead yields at the bottom means it has a more a greater potential to be predictive, whereas a moving average strategy, so I'll show you what that looks like. So let's go back to the S&P 500 and say, let's say I want to create a moving average strategy. This is so easy to do. I could just create a strategy that says, hey, when the 50-day moving average rolls over, I want to sell. But you don't want to do it too often because there's undulations in here. So I might say, well, 2 weeks after it rolls over, I want to sell. And then, if it keeps going, sell more and sell more and sell more. And then the market starts to go up. Well, I better buy. And so you see these all kinds of strategies, or the moving average is crossed over, or this happened, or that. It's so easy to make. But no, this rally doesn't make any sense, aside from the fact that people want this to be the bottom because they said, I'll get out at the top. Well, they didn't get out. Excellent video today as always. Thank you very much. I love it when you cover bonds and treasuries. So do I. Because it's one area I want to increase my knowledge and portfolio. That's great because I will say this. If you know the bond market, mainly if you, and I don't mean bond as understanding just mainly yields. If you understand where yields are going, which is the inverse of bond prices, it really tells you where the economy and where everything else is going. It tells you so much. So I think that's great that you want to learn more. And it wasn't until I started studying the bond market that I realized you don't need to know a lot about stocks. Everyone's so focused on PE ratios and book values, and well, that doesn't matter. It doesn't matter in a bull market. Fundamentals don't matter. They never matter in a bull market. What matters in a bull market is, did you get in, 12 months within the bottom? If you could buy a bull market 12 months from the bottom and do it successfully, you're going to make plenty of money. But the bond market tells you. So just need to know the bond market. Whoops, didn't mean to do that. Okay. Next question. Your passion plea for sanity and empathy with the fact that 10 plus million people, since I got this question, it's now 16 plus million people, and after tomorrow, who knows what, are out of jobs is apropos. It's so surprising that narrative isn't more prevalent in reporting. I know, I don't get it. And financial reporting, it's almost as if, these now 16 million people don't matter. And they do. And if you're one of those, you do really matter a lot to the economy. Maybe the silver lining in the cloud is that if you're being forced to cash out your investment accounts to get by, at least it's better to cash them out while they're up, not down. Especially since the consequences of tens of millions of people not consuming. See, this person here is a great thinker. They're really thinking past the problem and what, so many people are like, it doesn't matter if people lost their job. Yeah, it does. Not consuming in a consumer and service-based economy. Bingo. Couldn't have said it better myself. He says, let alone the human factor of losses and impacts to hearth and home. Like I said, great thinking there. I mean, that it is. I mean, when you lose your job, it's emotionally, it's hard. If you're the breadwinner in your family and you come home and you got to look at your spouse and your kids and like, how am I going to feed you? How am I going to put clothes on your back? How am I going to keep the roof over your head? Yeah, it's hard. All right, let's continue on. Anyways, if there has only been a single bottom, should financial reporting outlets such as MarketWatch, Barron's, Bloomberg, all of them keep saying why do they keep saying we've hit the bottom? It's time to start buying. Why are hedge fund managers and analysts at Goldman, JP Morgan Chase, etc., saying it's time to get back in? Well, here's why. In my experience, they're selling. It's really interesting because Jamie Dimon, the CEO of JP Morgan Chase, while 2 years ago said that yields were 10-year treasury yields were going to 5-6%. I could mathematically pretty much prove that was not going to happen. Now, I'm going to also assume that Jamie Dimon is much smarter than I am. And if he's not much smarter than I am, then I'm assuming that the people he surrounds himself with at that bank are a lot smarter than I am. And I know that is true. So why would he tell people that? Well, what happened later on is we found out that his bank was they were telling their clients, their hedge fund clients, to short 30-year bonds. Meanwhile, they were buying 30-year bonds. Now, isn't that interesting? So JP Morgan Chase was one of the biggest buyer of treasury securities of all the banks. And they're telling people to short when they were buying. See what he's saying? I'd never, ever, ever trust the news outlet. That's why I don't even have cable TV. I don't watch any of these news sources, period. Can't stand it. They're wrong. They're reacting. You got to remember, the market makes the news. The news doesn't make the market. The news is trying to figure out, so what happened today to justify stocks going up or down? That's what they're trying to figure out. But yeah, I never listen to those people. Or if I do, I just try to figure out what their motivation is, and I assume that it's time to do the opposite. History indicates that every recession or bear market has at least and sometimes more market bottoms, and we only had one so far. Why the heck would this be the bottom? Because people want it to be. They believe in the Federal Reserve. They think the Fed can prop up asset prices. So the Fed does more easing. So they're going to buy in because they have no clue how the system works. They don't really understand it. But in their mind, when the Fed's easing, you buy. Well, when the Fed was tightening, the market went up. So what you're telling me is, doesn't matter what the Fed does, buy stocks, which is pretty much what most people think anyways. So now people really think you should buy stocks. Well, what's going to happen is the market will eventually roll over. It will go down. And all these people are going to lose faith in the Fed. And when they lose faith, they end up selling. You'll see. And plus, they all said they get out before the next crash. They never do. Never. Is this just the market makers trying to pump the dying heart of this market to get more retail investors to sink their cash into a failing system? Yep. Plus momentum-driven market. So you have momentum strategies chasing momentum strategies. And what that does is it gets retail investors to think, and they'll say things like, well, the market is pricing in the end of the coronavirus. Okay, what market? What is the market? Well, the stock market is. Okay, well, who then? You mean the computer programs that don't read the news that trade 80% of this market? That market? Yeah, no, the market rebounded off a low. It found some buyers. And then the momentum strategies start to kick in. And then retail investors who sold now are playing chase again. And then you get professional money managers that are also playing chase, because a lot of professional money managers, if they're not hitting certain targets or they're not chasing the right chase, their clients will fire them. They don't have what it takes to come out to their clients like, hey, you know what? We got caught flat-footed on this market, and I'm sorry. But here's the deal. I could go play chase on this next rally, but odds are it's not the real bottom. It's going to roll over and go down. So I can play chase and risk losing more of your money, or I need some grace for you to be patient for several months, maybe a year, and let's this thing work its through the system so we can be on the right side of the market. Money managers don't do that. They play chase. It's like hockey. You hear the phrase dump and chase, where they hit the puck all the way down to the other end of the ice. Sometimes they do it for a line change, but then they skate down and go after the puck. Yeah, that's what investing is. It's dump and chase. All right, let's see. I just finished the latest video. Thanks for answering my gold bond question. You're quite welcome. Your explanation made sense. That's pretty cool. And he said, as usual. Well, I don't think all my explanations make sense, but I'm glad they did for you. And I want to add, I wasn't trying to disagree with your gold call, and you should feel free to. Look, I'm not the sayer of truth. Now at home I am. My wife's probably laughing right now. So I get to be the sayer of truth at home. But I'm not. I look at the markets through a different colored lens than a lot of people. And I've said to you, and I will say again, there's a good chance I could be wrong in my gold call. I don't think so. I think I'm right, but I could be wrong. So it's okay, because the great thing about macro is you can go out and find people like me that talk about things and give you research. But that's why I try to back up all of what I say by data. Not just data, but charts, graphs. And then when I'm done with those, I find some more. Because you build a view, right? And you say, okay, well, I think this was going to happen. And so you go look at some data. And then the next thing is a macro guy. What I like to do is go put holes into it. Okay, let's see that view that I had supporting this is real. And then you got to go out, create some more data and look at some more data and look and say, hey, is this right? That's how I approach it. What happens when assets, junk bonds that the Fed is buying, default? Taxpayers foot the bill. The Fed does not lose money on this. We as taxpayers, the U.S. Treasury earmarks money to cover losses. If it's above and beyond that, the U.S. Treasury will cover the losses. The Fed cannot lose money. So we as taxpayers, we foot the bill. Okay, and this will be the last question until Friday. Both SPY, the S&P 500, and TLT, the long-term Treasury bonds, have formed a cup and handle pattern. What are your thoughts? Okay, well, first let's go and look at what this question is referring to. And it would probably help if you could see the chart. So let's start with SPY. And let's zoom out. And I don't see a cup and handle pattern here. So when I'm looking at macro, I'm looking at the big view. To me, there's nothing cup or handle-ish about it. Now, I kind of know what this person was referring to. And they were talking about, if we zoom in, here's a cup, here's a little handle, and then what should be a breakout in the bull market. Now, as a macro guy, I'm not interested in, I do find smaller chart patterns entertaining, but I'm looking at the big view and I don't see a cup and handle pattern. Now on TLT, here's a cup that went from mid 2016 all the way to mid 2019. So a 3-year cup. Here's your handle, right? You got to visualize the two cayenne lines as your handle, and then it breaks up, and it's not quite into a bull market yet, but it's almost there. It breaks above this 179 and off to the races. This thing is in a validated major bull market. That's a cup and handle pattern. So let's go back and see what the rest of the question was. Oh, that was just it. So yeah, if you're more of a micro trader, day trader, week trader, month trader, the smaller patterns could have some relevance. To me, it's just amusing. I'm looking for the big patterns because the big patterns tell me a story, right? A cup and handle pattern is over a 3+ year period in the bond market. It tells me something, because if we go and look at 10-year treasury yields, sometimes in a macro, you have ideas, right? And sometimes charts give you ideas. So when I see this chart of 10-year treasury yields going back to 2012, 1, 2, 3 bottoms, I said there's no no quadruple bottoms, because it breaks through. Now, that means people have been buying bonds since 2012. The smart money's been buying bonds since 2012. Now everyone thinks this is the bottom. And my answer is, how can I be buying bonds for 5 to 6 years and exit them in a matter of a couple of weeks? You can't. So this big pattern here is telling me a much bigger story, and that I might have to go do some macro research on to find out what it's telling me. But from a charting standpoint, it tells me not only the yields are going to go lower, it tells me they're going low enough where all these people that bought are going to be able to sell, which is fantastic. Okay, let's get back to the gold playbook. And the gold playbook says, when yields and CPI are falling, you don't want to buy gold. Okay, but everyone wants to buy gold right now. It's in hot demand. And I think people are on the wrong side of the market. So again, thank you for your questions. We'll carry on from, let me mark that, and we'll carry on from that on Friday. Okay, so let's take a look at these charts. Here's real yields. And so we've seen real yields falling, and I say real yields are going to go up as inflation falls, and that is going to drive the bond market way higher. And so let's overlay gold, which is in red. And you should be looking at this from a long view and say, well, there appears to be an inverse relationship. So let's add that. Whoops, that shouldn't be percent change from a year ago. Maybe that would help. Let's fix the chart a little bit. And, oops. You can kind of see the inverse relationship a little bit better here. 0 minus A. And there it goes. So what does it tell us so far is real yields go down, gold goes up, is what you see here. Real yields falling, and gold isn't really going up. It's really flat in here. It doesn't go up until late 2000s. But let's zoom into the quantitative easing world, because that's really what I'm more interested in. And what you can see is this beautiful relationship here between an inverse of gold and real yields. So that's pretty cool. So what it tells me is if real yields are headed up, which is what my view is, which we covered in Monday's video. So if you want to go back and watch that, then what you have to agree when we uninvert this now, so you can see, is if real yields are going to go up, so bond prices can go up and gold prices have to go down. That's what it tells me. That's why I believe gold is going down before it makes its next big move in the bull market. Now, why do I think it's making a move in a bull market? Well, you have to go look at the dollar. And if we zoom out on the dollar chart, you have a massive topping pattern in the dollar that goes all the way back to 2015. And so as I believe the dollar will go higher, and then the Fed will have to find a way to get the value of the dollar down. You have a massive topping pattern and that supports gold going up. So does real yields, because once real yields go up, they're going to head back down. There's your trigger point to look at buying gold, and the dollar just gives you kind of a big kicker on that. So I'm Steve Van Metre. Thanks for taking the time to watch. We'll be back with you on Friday to talk more macro, answer your questions, and try to make sense of markets that don't make any sense. Bye now. The content of this video is provided as education and information only. It's not intended to provide investment or other advice. It is not to be construed as recognition or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity of business. Expressive video that I'm on do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.